I read this stat, Dom, that was really interesting. The top 10 tech companies in China right now, I think they're worth about $2.5 trillion. In the U.S., the top 10 technology companies are worth $25 trillion.
Their open source models are well ahead of us. And then on the application layer, we have to be quite mindful because their applications are very fast moving.
From an American investor point of view, this is a really interesting question because it depends on how much American investors want to pay attention to these open source models, which are gaining a lot of relevance and a lot of steam abroad. And it really comes down to this question: what is the global AI system going to be built on? Is it going to be on the American stack or the Chinese stack? And two very, very different propositions. The American one is, you're seeing hundreds of billions of dollars being spent to develop the infrastructure and the energy and the chips for this ecosystem, whereas the Chinese one is being built more efficiently. They have the power already, but they're spending far less in terms of, CapEx.
China's well ahead of us on energy.
Currently today, and the trajectory that we're on, is there enough power right now just in the existing grid?
The short answer is no. I mean, we've written a series of notes called Something's Gotta Give, where we voice significant concerns around all the compute being purchased by some of the companies that you mentioned previously, that there's not enough energy to fulfill all the demand. And it's showing up in electricity prices, for example.
In China, they just really press forward. And you say in China with pretty, friendly regulation. Tell me if that's a fair way to characterize it. You say the average construction of a reactor is 5.7 years. Does that mean it would take longer here in the U.S.? And what does that mean about our ability to meet the demands for power that these AI data centers are just creating?
This is a good one, Contessa. So according to a memo obtained by The Information, Sam Altman told his employees that he expects, quote, the vibes to be rough out there for a bit, as Google's recent progress could create some temporary economic headwinds for them. Now, that line, temporary economic headwinds, it gets at this emerging narrative in the AI race: hype versus hard economics. And Google's numbers, they are first in class. Gross margin of 32%, cash reserves $112 billion, free cash flow over the last quarter, $24 billion. Now, OpenAI, on the other hand, isn't even profitable. It's burning cash fast, and it has to raise again and again just to keep pace with a company that can fund its entire AI strategy out of search profits.
We've raised equity as a private company, very kind of typical path, but we've raised a lot. We're building a really healthy business, so free cash flow, CFO's favorite way to fund anything. That is absolutely climbing quickly. But I think the third area we've gotten into is really working with our ecosystem to do some really interesting financing deals. I'm particularly proud of the AMD warrant structure that we put in place just a few weeks back, because it's very strong alignment of incentives. What we've seen is when someone comes out and says, we're going to work with OpenAI, they immediately are often seeing kind of impact on their stock price. This is where we're looking for an ecosystem of banks, private equity, maybe even governmental, the ways governments can come to bear.
Meaning like a federal subsidy or something?
Meaning like just, first of all, the backstop, the guarantee that allows the financing to happen. That can really drop the cost of the financing, but also increase the loan to value, so the amount of debt that you can take on top of an equity portion for
so some federal backstop for chip investment.
Exactly.
Really, this Quen chatbot breakout, it reinforces the pattern that Wall Street is starting to appreciate in the AI era, and that is that real breakout products come from companies with the full system. That means models, distribution, infrastructure, data. It's a proof point for Alibaba, much like Gemini 3 was for Google last week, that the company has something that its rivals do not, and that is a full stack or an end-to-end system. China is now banning its tech giants from buying NVIDIA chips, urging them to switch to domestic accelerators from Huawei, Byron, and more threats. Hardware they control with no risk of future U.S. restrictions. And all the meanwhile, Chinese labs, they continue to release models that compete with the leading U.S. models, but at a fraction of the cost and compute. The U.S. attitude towards AI versus China, which is very different, right? It's kind of an attitude of spread their AI ecosystem everywhere as quickly as they can through open source, but also you're saying on the hardware side, right? You mentioned Huawei. Do you think that investors are appreciating that risk?
No, I think many people, like what does impact us, this is less relevant to whether or not we sell to China or not, is that they are going to sell that to allies, to people we're trying to influence. And they're going to offer it at basically zero marginal cost, like almost like free. And we're here being like, well, should we allow people to buy our infrastructure? The world is embracing open source. It's not embracing, you could say, like closed models, private models.
So perhaps some dislocation there. I don't know, but maybe.